This is The Big Story presented by HerbChambers.com.
I'm Steve Syre. I write the Boston Capital column in the Boston Globe, and I've been spending the day watching the stock market. This was the first day that investors had an opportunity to react to the Standard & Poor's downgrade of U.S. Treasury debt from its AAA rating, and we expected a volatile day. We got that and more. It started out down about 200 points and ended up down 664 on the Dow, a big number. The Standard & Poor's 500 index did even worse on a percentage basis. It was down between 6 and 7%. And if you looked at all the 500 stocks that make up that index and said what number actually went up today, that total was absolutely zero. So 500 stocks went down, none went up. That gives you an idea of the breadth of what was going on. The stock market is reacting to a growing sense that the economy is slowing down. We might even be going into another recession. That's certainly bad news for all kinds of businesses that have been profiting very well, and we've made money either in individual stocks or in our 401ks investing in those companies. If you look out and say, well, what should I do now in that respect? It's very hard to say. These indications that the economy is slowing down is certainly true, but to what degree is very hard to say. And as we've seen the stock market sell off for 2, 3, 4 days, clearly there's a fear factor going on that doesn't necessarily reflect reality. It's very hard to say, okay, I'm going to make a big decision right now, and I think that would be a mistake. We're watching to see how things develop. I'm not sure that things are going to get better or worse immediately in the short term. The one thing I'm pretty sure about is that volatility, this jag up and down, is going to be with us for some period of time, but I don't think that's a reason for the average person to do anything drastic in their portfolio.